Welcome to LendingCon Series 3, folks. This is an event for hospitality, development, financing, networking, which includes SBA loans, bridge loans, and any other financial instruments that hoteliers, developers need. So today we have an esteemed guest for our podcast, Paul Darrow, who's the founder and CEO of PhD Financial Solutions. He will be providing us insights into the latest in the lending market. Welcome, Paul. Could you tell us a little bit about yourself and your organization?
Yes, absolutely. Thank you for having me. It's great to be here. And hopefully we can shed some light on some of these topics. I've been in the motel lending business for the past 40 or so years. My firm does several things. We're kind of a one-stop shop. We help people finance their purchases, refinance their existing properties, help them with PIP financing, help them with purchasing or selling their property, and help them if they have a cash flow issue, we help them modify their existing debt.
Very
So
nice,
that's,
Paul. Thank you. I have a few questions related to the lending market. We're living in very interesting times. The first question, fixed interest rate versus variable interest rates. With the interest rates at a 20-year high, does a variable rate make more sense than a fixed interest rate right now?
it could. Every deal is a little different, and the needs of the hotelier may be a little different. It depends on how long they want to keep the property for, because refinancing is not an inexpensive process. Um, if they want to sell the property quickly, it's a different answer. So what we need to really look at is the goals of the hotelier. If you're in the long-term position, I would say a variable rate mortgage where the rates fluctuate with the current market. You may see in the next 18 months or so or 2 years rates starting to come down, and in a variable rate, you'd get the benefit of it coming down. If rates continue to go up, then you get the negative of continually paying higher and higher mortgage payments. So it depends on your time frame and what your personal situation is. If you have plenty of income and you don't want to worry about rates, you want to tie it up for a long period of time, that becomes a business decision for you. But for most people now, I would say if you're going to refinance into a variable, not as much into a fixed rate.
Fixed rate. Thank you very much. Second question that it's more related to the refinancing versus actually the fixed versus variable. Would you choose a lower down payment and a higher interest rate, or a higher down payment with a lower interest rate with the current existing interest rate market?
Yeah, again, depends on the situation of the hotelier, but basically what I would recommend is that we take a higher rate and a lower down payment. And the reason for that is you take the differential between what you would have put down for the lower rate and what you end up putting down for the higher rate. So there's that spread. For argument's sake, let's say you're buying a $3 million property, and conventionally you have to put down a third, so you're putting $1 million down. You could take that same loan, put it into a government-backed instrument where maybe you can get in with 15 or 20% down, and you take the difference between 400,000 and a million, and you take that $600,000 and you invest it at 5, 6, 7%, more than outstrips the different cost and rate, and you have all the money. So it's better these days. It's better to hold on to cash. Cash will be king. You
Cash
might
is king.
find that there's another opportunity that you need that
Right.
cash for. So
Yes.
I would say hold on to cash.
Cash. Thank you. So which brings us to our next in the same lending environment, which is refinancing or modifying the existing loan that you have. If you're having issues making your mortgage payments, does it make more sense to modify your existing loan, or totally get a new refinance?
Chances are you can't refinance. If you're having trouble meeting your current payments, you have insufficient cash flow to refinance. because you need the money to pay for the new mortgage, which is going to be more expensive than probably what you're trying to get out of. So you may not have any choice but to modify. Your only other choice is to lose the property, really. So modification is a great tool. It's not for everybody. If you can meet your payments, make them. But if you can't meet your payments, there's a lot that can be done to dramatically decrease your mortgage payment without being in default, without any effect on your personal guarantees or credit score. Um, they are a very, very handy tool. They're part of the SBA guidelines, called their Standard Operating Procedure Guidelines. It's called, and there's a whole system set up to take care of situations like this. And we do a lot of them, and it's much better than trying to refinance. This is reminiscent of 2008, where interest rates went way up. Loan windows at banks were closed, so you couldn't refinance. A lot of people went into foreclosure, and in those years we were helping hundreds of people with this problem, almost 100% successful. So it's a very valuable tool. You should not go bankrupt. That solves absolutely nothing, because your corporate bankruptcy, which you're trying to save your property with, does nothing for your personal guarantees. So 80% or more of Chapter 11 restructures in bankruptcy turn into a Chapter 7 in bankruptcy, and a Chapter 7 is a liquidation. So you spend all this money with lawyers through a bankruptcy, and it's no fun, believe me, in bankruptcy. The laws are not meant for you as the borrower. They're meant for your creditor. Okay,
Right.
so everything is stacked against you in bankruptcy. And you think it's hard to get a loan, wait until you're in bankruptcy and they want your weekly reports. Okay, so
Paul, so your organization, it's been helping a lot of folks for years. What would you consider your forte, or where you can help hoteliers, new development, or PIP renovations may be?
yeah, that's a great question. I think that the PIP financing, straight PIP financing, you need more mattresses, you need more TVs or whatever, is a very expensive process. So I think the thing to look at is what your existing debt stack is, see what kind of loans you already have, and see the most economical way to finance your PIP. Sometimes it's to just take out a whole new first mortgage that includes the PIP financing, because PIP financing generally gets paid back in 5 to 7 years. And the rates aren't so terrible, but because it has to get paid back so fast, your payments are huge. So most people can't afford PIP financing.
Oh, okay.
And we can get that PIP done for you at a much more reasonable cost.
Reasonable rate, yeah. Well, thank you, Paul. I really appreciate you taking time and giving us insights about the lending environment currently, and I hope to see you at the LendingCon event. I hope to discuss with you more. Folks, as you can see, Paul has been in the industry for about 40 years doing this, and so he knows just about everything there's to know, and he's helped numerous clients, and his firm is they'll be present at LendingCon event, and we will get a chance to meet them in person. And thank you
Come
very
by and
much,
see
Paul.
us.
And as you know, folks, this LendingCon event has been founded by Jan Gautam. He's the president and CEO, as well as chairman of Intercent Hotels and Resorts Management Company. Paul and Jan have been working together for numerous years, Paul. And I thank Paul, and I thank Jan for this LendingCon event. Thank you very much.
Thank you.